Andrew Holland, CEO at Avendus Capital Alternate Strategies. He's joining us on the show right now. Andrew, good morning to you. While we have been making our approach back towards those levels of 10,900, 11,000, it's the global markets and the sentiment around thereof that is something that we need to really be careful of. And that could be a major risk to this uptrend that we've been seeing in the last few weeks. What's the sense as to how much in terms of a trigger could the global market sell-off mean for us?
Yeah, obviously it's going to have a a negative sentiment impact, but I think thinking about 2019, I think you're going to have bouts of weakness in developed markets, which is going to be a great opportunity, to pick up stocks in India, because the way I'm thinking about it is that when we hit highs in August of this year, the oil price was at 80. And we had a more hawkish RBI governor, and both of those reversed significantly in the past 1 month. So, with a lower oil price, obviously that's great for the deficit and for inflation. And given that, then obviously the new RBI governor, I think, who will probably be more business friendly, has the scope to reduce interest rates. So I think the liquidity, problem that we were facing maybe September, October anyway was going away. And this will be helped by further kind of liquidity and monetary policy by the RBI, which I think will be more accommodative. So, all of that lends itself to the markets going higher. But you're right to say, global sentiments will be there. But I think that's the opportunity in now and 2019 will be these opportunities that will be given by developed markets, where I think that the problems are real. Compared to India, where we're still growing at 7.5% GDP growth.
Andrew, I'm keeping it global, for the moment, because that's one of the for our domestic factors. Most of the overhang is out. We had the state elections out of the way, the appointment of the new RBI governor. But for the U.S. markets, there were 3 probable triggers that could have reversed the downtrend that was being seen in the U.S. equity markets. 1, valuations being cheap, that didn't encourage bulls to come back into the market. 2, the previously dovish commentary from the Fed chairman, that didn't manage to excite the markets. And 3, even a moratorium on the trade war has not managed to do anything for the equity markets. So is this risk more real and a further downside even after the kind of sell-off that we've seen on the U.S. equity markets? And could that mean a bigger blow for us?
No, see, let's put this into context. First of all, despite the falls in the U.S. market, for the year it's probably flat to very small negative. So it's not as though it's been a disastrous year for the U.S. market. It's just off from its highs of the year, like most markets in the world. So I think we're playing too much on that. I expect the Fed chairman in his statement on Wednesday to be a lot more dovish, because I think whilst he might still raise interest rates, I think some of the indicators coming out of Europe and the US is of a slowdown. So I think he'll be more accommodative in what he says about the interest rates moving forward, and I think he'll move away maybe from inflation targeting to how the US economy is actually faring. One of the mistakes that the Fed Reserves make over many years is raising rates when it shouldn't, at probably the wrong time. And it's probably the wrong time now, because the US is slowing. The trade war, if it continues, would probably mean that more and more people will talk about a recession in the US economy. And this is why I'm saying it's a developed market problem. This year, if you look at emerging markets, they're anywhere, depending on currency, anywhere down between 5 to 30%. So I think a lot of the pain has already been taken there. So I think it's the developed markets I see in 2019, which will drag emerging markets down, but relatively I think we'll be better off. And I think once dust settles on some of this, then it'll be fine. So I think I'm not trying to put too much emphasis on developed markets, because they will have a sentiment impact, but that doesn't take away the fundamentals of what we have in India. And the fundamentals in the very short term are very positive, for the markets. So if you get a dovish Fed, on Wednesday, then markets might take a bit of a relief in terms of that interest rates aren't moving as quickly in 2019. But on corporate earnings, I would say that for the US companies, I think there will be some downgrades coming. So therefore, valuations which you mentioned are cheap, probably not as cheap as people are thinking.
Andrew, okay, and that's a fair point too. I mean, 2019 was a year of some extremely strong earnings growth for the US companies. Maybe it fizzles away a bit in 2019 rather. 2018 was a strong year. But Andrew, just wondering, I remember a conversation about, 2 or 3 months ago, where you were sitting on a fair bit of cash. You're sounding a lot more sanguine about India's prospects. Have you deployed some of that cash already, and would you look to increasingly be fully deployed at some point of time within the next couple of months?
See, what I've consistently said, I think, 2-3 months ago when the markets were falling, I said, you're getting good opportunities in certain stocks, and therefore we would look to deploy some of that towards that. And that, that's what we've done. It's not as though we're kind of rushing to the markets. There's a lot of moving parts, and up until last week, you had quite a number of, kind of different events which could affect markets. Ranging from our own state elections, but then you had OPEC, you had quite a number of events, and we still have them. We've still got the Fed, we've got Brexit, where there's now no confidence vote by Labour for the Conservative Party. So there's many moving parts at the moment. So I think you've got to tread carefully. It's going to still be a volatile 6 months. I'm not taking that away. So we'll continue to tread carefully. But if opportunities present themselves in certain stocks or sectors, which we feel are more compelling because of global markets or local factors, then that's when we'll step in. But don't need to be aggressive in these kind of more volatile markets.
Which are the safer haven pockets right now within the Indian equity market, Andrew, that you're spotting as an investment opportunity from a 3 to 5 year horizon?
Well, 3 to 5 years is probably the whole market, but I would say that in the very short term, the places to hide remain kind of FMCG, where you have very strong growth, and obviously the safety in terms of defensive sector. IT still looks okay, going forward, and we've seen some of the more beaten down stocks, whether it's in the banking sector or the auto sector, start to recover quite strongly as sense prevails, and not everyone is tarred with the same brush. So I think that will be the continuing theme for the next few months. It's going to be more liquidity driven and momentum, and that's really where you're going to make the money in the very short term. So I think the next 1 to 2 months is a better environment for India, particularly given I think the RBI does had scope last time actually to reduce interest rates. But then, as we get towards the elections, it's going to be a little bit more volatile. And of course, in 90 days, we'll know whether China and the US have moved to any kind of resolution. I suspect that both will want to do that very quickly, because both the economies are slowing very quickly.
Specific, a pocket that I would like to talk about is the auto space. And this particular period has not been all that good. So be it your, except for your truck makers and your tractor makers, you've got some pain points in your passenger vehicles, your two-wheelers. So it's not been all that good even in terms of your monthly volume numbers. Do you see that turning around anytime soon?
I think it will kind of remain stable now. You're coming off very high growth rates, so there's got to be at some point where you settle down. I think it was. I think it got impacted in October, November, with the kind of the mess that we're seeing in the NBFC sector, and I think people sat on the hands of it with higher interest rates than they normally would. But again, I think now you just look at where bond yields are, and I think things are getting back to normal. Therefore, the whole NBFC sector will start to improve. But again, I'm not saying that across all companies in there, because there's quite a number of companies who shouldn't be doing that kind of NBFC business. So I think that the bigger will get bigger in this space. It's a bit like what happened with the private banks and PSU banks. The bigger will just get bigger and take more market share, and that's really where you need to focus.
Okay. Andrew, it's an interesting analogy. What do you do? I mean, if you mentioned that autos are a bit like private banks, so the larger become the largest, would it be across spheres in the auto space, or would you pick and choose four-wheelers, two-wheelers, tractors within this bucket as well, even if you want to bet on the larger names?
Yeah, we're probably looking more at the four-wheelers and the two-wheelers at the moment. Obviously, if there's an improvement, then the auto part makers obviously become into play as well. They were beaten down quite a lot. So, I think you've got to be very selective. I'm kind of loath to kind of mention names, but in terms of stocks. But, I think we all know the kind of companies that got beaten down in October, November, October in particular. And those are the ones which have rallied, more significantly. So the quality will always stand out, and I think that's really what we look to do, and which is why I said at the very beginning, if global markets are has a risk-off trade and it provides opportunities here, that's great news, because they are going to be good opportunities to buy.
Andrew, now that the liquidity situation has become a bit more better, since the IL&FS crisis, even for some of the NBFCs, they are getting those bank lines going for them. You are seeing rollovers, almost 70-75% of CPs getting rolled over. So with things improving, are NBFCs a pocket that you would be interested in? And if you have to bifurcate within NBFCs as well, what would the sub-pocket be?
I think just, again, go to the quality NBFCs. I think that's where you need to be positioned. Again, without trying to go into any particular name. I think what happened was that every stock got tarred with the same brush. And really what was needed was at that time just the RBI to step up and say, we're going to make sure everything's okay. It didn't. It did it quietly, and liquidity was provided. So there was actually no real problem, in the sector. It's just a matter of confidence, and confidence is key, right? That confidence is now back, and if the RBI governor, or the new RBI governor, helps that along, then you will see. The re-rating or the stocks kind of which have been beaten down start to recover a lot more. The other thing I would say is that, obviously we expect the government to do some form of measures towards the elections. If it does this, I'll be even more excited. Is that with the government's obviously now has been spending a lot of money on infrastructure. If it can just help kickstart the kind of consumption a little bit more, then GDP growth and could accelerate, and I think that would be great news for the economy as well. So it's just a matter of tweaking here and there. I'm not saying go with populist measures, but if you can just tweak it to get the consumption moving again, particularly in the rural areas, then I think you've got a very strong economy, and that will stand out globally.
Leave it at that, Andrew. Thank you so much for taking the time out and being with us, and have a great 2019.
Thank you.